You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, welcome to Options Playbook Radio, the program here on the old network where we break down the sometimes scary, sometimes amazing world of options into some offensive and defensive plays that you guys can utilize in your own portfolios. And sometimes, once in a while, we take a fun chance to answer your questions as well. We're going to do that in a little bit. If you're saying to yourself, hey, what's that guy's voice doing on this show? This isn't his show. You're right. Let me introduce your usual host, your usual options playbook guide, Mr. Brian Overby, the senior options analyst, indeed the options guy over there at Ally Invest. Brian, welcome back to your own program, sir.
All right. Yeah, it's always great to be back. It's always fun for whenever you and I can get together and answer some of these listener questions. And so it means it's time to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody. Welcome to the huddle. Like the man said, this is the portion of the show where we answer your guys' questions here on the old program. Brian, it's fun doing it remotely, but it was fun doing it in the same room over there at the Options Industry Conference as well. So that was a fun time. We'll have to get back in the same time zone again one of these days, Brian.
Yeah, it'll happen sooner than later, I'm sure.
I'm looking forward to it. In the meantime, though, doesn't mean we can't answer some of your questions. Let's get started. Let's see how many we can get to. Brian, this first one is quite up your alley. It's literally addressed to you, so I guess I'm chopped liver. I'll get the heck out of Dodge here. This comes from Chunky Monkey. I don't know if that's the proper. Maybe that's how they spell the flavor. I don't know. But he or she's asking, hey, cool show. Well, first off, thank you. He goes on to say, I like the skip strike strategy, easy for me to say, a lot, as it seems to be very customizable. I've been playing with it in my paper account to get a better feel for it. Obviously, the more strikes you skip, the less valuable that far out of the money wing will be. I'm curious if Brian has a rule of thumb for how many strikes he likes to skip, and is there a max skip rule that he won't go beyond? Maybe 10 strikes or 20% away from the last leg. Also, does he ever do regular old butterflies as well? Thanks for all the helpful info. Well, Brian, this sounds like you've created a convert here to the dark side of skip strike flies. I know you have. You and I have talked about this before. You have your kind of maxim around earnings. I know you like to go around the earnings straddle. That's kind of your strike demarcation there. But I don't know if you've talked about if you have some sort of max rule that you go beyond that. So what do you have to say here for our friend Mr. or Mrs. Chunky Monkey? I like that handle. That what are some of your rules of thumb when you're putting on these old skip strike flies? And also, do you still trade the old school fly, or are you all skip strike these days?
Yeah, well, obviously, I do enjoy skip strike butterflies, but the biggest thing on Options Playbook Radio is we're always looking for the timing of when you want to do the trade. I definitely have a rule of thumb when I'm looking at how many strikes am I going to skip? And hence, I've heard other people call this a modified butterfly. There's a few other names for them, but the bottom line is I like skip strike butterfly because that's exactly what you're doing. You're skipping a strike inside of the butterfly. And a lot of times, just because on Options Playbook Radio, we like to talk about earnings because the trade happens and then you get a reaction and then you can talk about what happened with it. So we end up doing a lot of skip strike butterflies. I do a lot of normal butterflies in my ordinary trading, but because we're talking so much about earnings, there's a lot of juice in those option contracts, and that juice awards you the ability to skip a strike and pay for a butterfly, and you can be quite a ways out of the money. So I have a couple of rule of thumbs, and I'm going to even throw one in that wasn't actually in the question. One of the biggest things, if I'm doing skip strike butterflies, I want it to be on expensive stocks because premium matters. And the more premium you have, the easier it is to just skip a strike and still be able to get this done for a net credit to the account. The second thing is I'm only looking to skip one strike because you're adding way more risk with every strike that you skip. Now, I should say that that's an equidistant skip. I don't mind every once in a while. I don't really like this. And Mark, you and I have talked about this before, but I don't like when they have half-point strikes and they try to get all these really tiny widths between the strikes, specifically on weekly option contracts. But if that's the case, I don't mind being maybe at a 50-cent width difference on your strike when you're skipping them because it brings in just a little bit more credit. But under the normal circumstance where you just have 5-point strikes and I'm doing, let's say, a 10-point wide skip strike butterfly, I only want to skip basically that 10-point strike that I would normally buy. And then the width of my strike that I buy past that is going to be 10 points wide. So on the downside would be 10 points. It would be a 10-point wide long spread. And on the short side, on the short spread, it would be a 20-point wide spread. And I specifically like to do that because that means that my total risk on that trade is going to be that 10 points. And another way to look at a skip strike butterfly that a lot of people don't think of, they're like, oh, this is such a fancy trade. But all you're really doing when you skip that strike and you're not buying it, all you're really doing is embedding a 10-point wide credit spread in that trade to pay for the butterfly. So when there's more juice and more premium, specifically further out of the money, the underlyings that we always talk about on Options Playbook Radio around earnings are Amazon, Facebook, which is now an expensive stock, Apple, an expensive stock, and of course, Google. So all of these stocks with a lot of premium in it that could potentially move around earnings, those are the underlyings that I really like to think about on skip strike butterflies. Now, with that said, we look at a lot of these trades around earnings. If I'm going to do it around an earnings, though, I always prefer a stock, and I'm just going to use one example because the last 4 earnings have had this scenario happen in that Amazon usually announces on Thursday, and then you have 1 day of trading on Friday before an expiration date. And to me, that's very big because on a very expensive underlying like Amazon, you need time premium to come out along with that volatility if that market is moving towards the precipice or that center strike that you've sold on your skip strike butterfly. So I like to do them for 3 things. Let's put the 3 things in here. As far as the skip strikes are concerned, I'd rather do them on expensive underlyings. It's nice if you're doing them around earnings because the more premium in it, the easier it is to do. I only like to skip one strike. So if it's a 10-point wide long spread, then the short spread is going to be a 20-point wide short spread to make the skip strike butterfly. And I prefer to do them. I'd rather have, if it's a round earnings, I'd rather have that earnings be on Wednesday or Thursday as opposed to Monday or Tuesday, just because we want that premium to come out of those options as soon as possible. And the only time I'm ever going to do it, just one last caveat, is if I can get it done for a net credit to the account and be at least one standard deviation away from what the expected move is. So I think that unpacked a lot on skip strike butterflies. I don't know. I don't think I can cover anything else, Mark.
I think you hit all the various facets there. Well, Joe, people are really gravitating towards the skip strike flies. You know, you're a convert. You clearly have made a lot of converts out there. I haven't heard anyone call it a broken wing fly to me in a while, so maybe you're slowly bringing the masses over to the dark side there, Brian. Let's see what else. We got time for a few more here. We got Brian. Oh, another Brian, your namesake perhaps. Brian P. writing in. He wants to know, what is your favorite underlying to trade options on? Great question. It's a fun one. I saw this question come in, I thought I would look myself and see, what have I been up to of late? 'Cause I tend to be, I don't know about you, I'm guessing you're the same way, Brian. I tend to be kind of underlying agnostic. I don't really gravitate to a few. That said, I think everyone who's very active in the option space is probably trading, for the most part, amongst the same 75 to 100 names, because as we talked about before, as we talked about the Options Industry Conference a couple of weeks ago, liquidity beyond that is kind of rough. So we're probably most of us are probably playing in and around the same universe. But I tend to move around a lot. I'm a bit of a flittering butterfly when it comes to that. Whatever attracts my attention and interest and has good setups. Like, for example, I was looking before the show, and primarily I've been trading a lot of VXX, options on VXX, which is, of course, the volatility kind of ETF out there to try to track the VIX, and then VIX options themselves. So I've been playing a lot in the vol space post February 5th. Go figure why that could be. So that's kind of what draws my attention. I haven't been doing a lot of single name equities or equity options of late. That's kind of been what's luring. I wouldn't say that's my favorite. I don't think I really have a favorite. I think that's just kind of what I'm into right now, Brian. Are you the same way? Are you kind of pulled hither and yon to interesting things, or do you have a couple standbys you go back to all the time?
I do have favorites, but it's mainly just indexes. And part of the reason why I like indexes, and it's more so in my individual account, is because there's some tax advantages. So I like the fact that index options are cash settled. And I also like the fact that there's a 60-40 rule, which means that if I'm doing a short-term strategy and it expires on me, or I get out of the trade, 60% of that tax benefit or loss or whatever I had happen on the trade is going to be considered long-term, and 40% of it is going to be considered short-term. So because of that, indexes like the S&P 500 index are some of my favorites to trade. Now, if I were to just generally group something, I mean, I love the fact that you're trading the VIX. That's a crazy underlying, and the premiums are just wild. But as far as my favorites are stuff that have a premium in it. And we talked a little bit about the Amazon or the FANG stocks. Those are very liquid stocks, Amazon, Facebook, Netflix, that have a lot of time premium in it. And part of the reason why I like that is because you can adjust the trade. I don't like trading, I'm thinking Bank of America, a $20 stock. It's a decent underlying, but there's no time premium in it only because it's a lower price stock. So my favorites would be higher price stocks that have some volatility and some predictability. And then I'm always going back. I always find myself in scenarios like where the market is right now, where you were talking about the VIX index and a little bit of volatility and some predictability. I always find myself in the S&P 500 index for the reasons that I mentioned.
Yeah, I guess in aggregate over time, it probably would come down to primarily, large indexes probably for me over time as well if I had to count the numbers. But it's not by I don't gravitate towards those all the time. It's just that sometimes that's what the setups are. We do a lot of unusual activity as well, so I get lured into a lot of interesting and intriguing things that are going on out there, just in terms of setups and distortions from a volatility. Someone's buying up a ton of calls, and it makes the skew just completely out of whack. So since we do a lot of that anyway, I'm in a somewhat unique position. Did we do a lot of that? So it kind of pulls me in a lot of interesting different places, which is fun for our shows. I get to experience a lot of different underlyings, and it tends to work out more times than not, which is a good thing as well. Again, not to follow the unusual activity, but to trade around the distortion that is created as a result. All right, we got time for one more. Here's an interesting one. Kind of a question that we used to get asked a lot. It hasn't come back in a while. I think it's coming back now for a reason. This comes from QZ98. They want to know, do you guys trade options on stock below $5? And then what's the cutoff? Is it $1? I remember, you know Alex Jacobson, Brian. He used to be on our Option Block show with us, and he used to have a cutoff. Anything below $10, he would kind of just turn his nose up at. He'd say, "Oh, the underlying is an option at that point." And I certainly concur with a lot of that viewpoint. But I could see, I tend not to do it myself because especially below $5. The stock really is pushing option territory at that point. So if you really want that exposure, you can get all of the Delta 1 in the underlying for about the same price as an option with no time decay, none of the other stuff you have to deal with about being right within a certain amount of time. That said, I think the reason we're getting a lot of this now, Brian, is because we were talking, people were hitting us up on our Option Block show earlier this week, where people are hitting us up a lot about HMNY these days, which is the name that people clearly are not reticent to trade options on a name sub $1. This is Helios and Matheson Analytics. You may know them better as being kind of the main majority owner of MoviePass. They've had a lot of, shall we say, volatility of late. The stock closing today, 68 cents. And yet people are slinging options willy-nilly on this thing. It did 18,000 contracts almost today. So clearly, Brian, there still is a camp out there that wants to trade themselves some options, even on a name where the stock is cheaper than most of the options you might want to trade. I don't know, Brian, what are your thoughts in general on options on cheap stocks? And then, is something like an HMNY, is that just a bridge too far for you?
First of all, yes, a bridge too far. I'm going to go with Alex's statement. Anything that's under $10, I think there's no real reason to trade it. And I'm going back to 2008 and 2000. When these big stocks, you had Ford trading down there, you had Bank of America trading down in the $2 or $3 range. And the one thing that I will warn, if anybody's doing these trades, and this actually happened to me, so I'm speaking from experience, where I was trading in a big name, and I don't remember if it was, I feel like it was Bank of America that was down under $5 at that point in time. And you got to really watch selling option contracts, because you actually kind of forget about the fact that you can be assigned. And if you look in a stock like Helios, a lot of times them exercising the option contract to try to sell stock is a better way to do it than going out on the marketplace, because the markets are wide, and sometimes, right now this is a fairly liquid stock, but who knows from a month from now where it's going to be. And so I had that happen to me where I had a couple of advanced strategies on, and I got assigned early just out of the blue. And I remember it specifically in the put side. And I just didn't expect it at all, because you just don't usually you usually need a reason for it. But in the put side, if the person wants to sell the stock, sometimes on these low price stocks, it's just easier to exercise, and you end up getting put the stock, and it screws up your whole strategy. So I just stay away from them. That was a lesson learned on my part, and I didn't expect that to happen, but it did. It happened to me. So the only way that I would trade these, and I really would normally just trade the underlying, is if I was buying options. I would never want to be selling options in these underlying type of stocks, which means you're just purely speculating because, it's a $5 stock, or in this instance, a 68-cent stock. 68
cent stock. That's it's definitely a new low for us on the network in terms of analyzing unusual activity on that cheap of a name. That's definitely a new record. But interesting. And you're right. There's a lot of interesting things that go on when you get that low, and sometimes surprising things. Usually getting assigned puts out of the blue can be a decent thing, but obviously it depends what's going on with the stock. If it's gapping down, not so much. And also just the surprise factor. Oh, I got the stock I didn't know I was going to have. So yeah, there's a lot that goes into that. You may not be aware of when you're getting into these. Great questions, everybody. Keep them coming. Brian, if people want to join us here on the show, they want to send you a question directly or just check out what you guys are working on over there at Ally, where should they go? What should they do?
They should definitely send me an email. My email is theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. And I always want to say thanks for listening. I would love to see you. Come back next time, same place. And until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.